I'm so excited to have you here. If you're watching on YouTube later, please remember to like, subscribe, and share this video with others. So today we're going to dive into how to invest and diversify if you have 250K to invest. I know for some of you, 250K is a lot of money, and you're thinking, "Whoa, I barely have 10,000 to invest, Camilla. What are you talking about?" Right? And then others of you have just sold a house or several houses, taking advantage of this hot seller's market, and you sold some places and you have a bunch of funds to invest. Or maybe you got an inheritance. That happens a lot too, and you get a big windfall of cash, and you're sitting there thinking, what should I do with this money? Or you have a ton of money sitting in the stock market that you want to bank. I call it banking it. So you can take advantage of the big gains that you were able to achieve through the stock market and now move it into stable real estate to make sure that you keep those gains that you achieved in the stock market. So we're going to talk through diversification. So starting off, just who are we, right? SteadyStreamInvestments. We help you build wealth by investing passively in multifamily syndications, which is just a fancy word for group investments, to really help you have that financial peace of mind and leave a legacy for your family. So today we're going to learn three things. Number one, what is diversification? Number two, why is it important in real estate and in investing in general, really? And then number three, how to invest and diversify if you do have 250K to invest. Okay, so first off, what is diversification? Well, it's just simply a technique that can help you reduce your risk by, think about it as peanut butter, right? You're going to spread peanut butter across the whole bread, and that's going to help you to be able to have a better sandwich, right? So you don't just have peanut butter in just one little piece of your sandwich. So the idea here is really to try to maximize your returns. So you don't want to invest in just one thing. If you are a stock market investor and that's all you've known up to this point, like I was for a while, you think you're diversified because you put some money into like the foreign stocks and some money into large company stocks, some money into small company stocks, etc. And that's what the financial advisors will tell you is diversification. However, that's diversifying just in the stock market. So you're still only in one asset class. Whereas there's a whole other world of investing out there. And that's the investing that I like to talk about is the government refers to it as alternative investments. So alternatives to the stock market. And diversifying outside of the stock market really strengthens your portfolio and helps you to maximize your returns. Also, you got to expect the unexpected, right? We never know what's going to happen. Nobody ever knew that COVID was going to happen, for example. I think I watched a documentary where it said Bill Gates had predicted that there would be a pandemic at some point and the world would be crippled by it. So he's a really smart guy. But you just can't predict what's going to happen, right? And so if we look back in history for real estate and the stock market and the economy, there's cycles. We go through these cycles. We go through, great prosperity, and then we have kind of a dip, and we go through a little bit of a tough time. So these corrections and recessions, they occur every so often. So it's really important that that you prepare your portfolio to make sure that you can withstand any fluctuations that happen. So why is it important in real estate? Well, it's a really powerful strategy to weather any economic cycle, right? So it's going to maximize your growth and lower your overall risk. So we're going to talk about how to kind of diversify in real estate. So the first thing you can do is think about diversifying into different types of assets. And in commercial real estate, which is where I'm focused right now, there's lots of different types of assets. There's retail, right? So you can buy a shopping center. You could buy, I know investors who they only buy CVS stores, right? They own the real estate. They don't own the store, but they own the land and the building that it's in, and then CVS rents from them, right? So that's an example of retail. Or you could just go buy a little strip mall, right? And then you could lease out those ones to, those to small businesses. Number two is self-storage, and self-storage is large storage facilities that people will rent typically on a month-to-month basis. Sometimes there'll be a 6-month lease. It just kind of depends. Really great asset type to invest in because they're pretty strong in any type of economy. If people are doing well and they have lots of money, they'll go out and buy extra toys, and they need somewhere to store them. If the economy kind of goes down and people have to start downsizing, they still don't want to get rid of their stuff because they think that, they're optimistic that the economy will come back or that they'll be able to make more money in the future. And so they just rent a storage facility and they go put it in there. So in any economy, self-storage is strong. There's multifamily. That's the one where the SteadyStreamInvestments focuses on 90% of our assets in there. And multifamily is super strong recession resilient asset type that really just has some powerful things to it. There's medical. You could buy the medical office buildings, and I know investors who are doing that right now. There's office. Now, office got kind of crushed during COVID, right? But they're coming back, and there's predictions that the offices will come back. Same thing with hotels. Hotels got really crushed at COVID. But we always know that the best time to buy is when things are down, right? So hotels are going to start to march back, and we'll see them come back strong probably over the next 5 years. And then there's mobile home parks, and mobile home parks is an asset class that a lot of investors are interested in right now and providing really good returns. But if you vary the types of properties you invest in, it gives you just even more security against the broader changes to the economy. All right. Another way to diversify is by location. So at any one time, right, there might be one city that's booming and a different city that is it's not going well for them. So you have to look for areas that are either growing or expecting growth. And then by diversifying your assets across multiple cities or states or counties, you can really take advantage of all of these amazing markets. And that's one of the great things about investing passively as group investors, because you're no longer limited to where you live. A lot of people, and that's how I started out investing, was I was like, okay, I want to invest in real estate, but I could only invest where I lived because it was just too crazy for me to think about investing in another state. Like I couldn't fathom, how that would even work. So to really take advantage of the best markets across the US, group investing is definitely your best bet. And then finally, asset class. So asset class is a way to diversify even further. So if we think about multifamily, for example, a class A asset is going to be your new luxury high-end amenity type one that has all the bells and the whistles and a lot of, oftentimes it's new construction. And that's how you get a class A asset. Class B is going to be between like 10 to 20 years old. Maybe, they have some amenities. They're still really nice properties built really well, and they're good performers. Class C are going to be kind of 20 plus years old. Often you need to go in and renovate the units because they might be quite outdated. But there's opportunity there to do that renovation and then raise the rents. And then you have class D, which are 40 plus years old, typically located in high crime areas. They're going to need a ton of work, really old buildings. Some people say D for dump, right? It just kind of depends on your risk profile. So certain ones will do better in different economies, right? So during rough patches in the economy, your class C's are going to be doing great, right? But during like booming economic years, which we experienced for a while, your class A are going to do the best. And so if you have a mix of those in your portfolio, that's another great way that you can take advantage of both, in both types of economies, you still have something that's performing well for you. Okay, so now let's get into, now that you have, so now we understand diversification, we understand how you could do it across asset type, right? You can do it across location, and you can do it across the asset class. Let's talk about like actually having $250K to invest. So option one here is you could definitely invest it all into one deal. Now we'll talk about the pros and cons of this. So one of the pros is you could earn a higher return. Sometimes on some of the deals that I offer will have different levels of investment. And so if you're like a level one investor, that means that you have the minimum. You come in with the minimum, which is typically 50,000, and you get a certain return. We have a different level of investor where if you come in with 250K, you're going to get a higher return. So you get incentives for investing a larger amount into the deal, which can be very appealing and can really help you to earn, right? Now, there's greater risk, right? If 250K is all you have to invest and you put it into one place and one place only, remember you're not that diversified. You've definitely diversified out of just being in the stock market, which is great. So now you've picked up a real estate asset, but you're not super well diversified in real estate, right? So there's a little bit greater risk, but there's greater reward. So here's what I would say to someone who, if they came to me with 250K to invest, I would first ask, have you invested in a real estate deal before? If the answer is yes, and then they say, hey, Camilla, yeah, I've invested in 2 or 3 deals before. I have 50,000 deployed in this market and 100,000 in this market and 50,000 in this market and across asset classes. I'll say, great. Okay, I think then investing the 250K into the one deal to get that higher return is a good option for you. Now, if the answer to that question of have you invested before is no, this is my first time investing into a group project, then I would say, well, although it might be appealing to invest all that 250K to get that higher return, you're not going to be super well diversified. And so you need to think about that and think about, can you handle the higher risk, right? Or do you feel like it might be better for you to spread it out across other investments? So that's option one. Okay, let's talk about option two. So option two is to take that 250K and spread it across multiple deals, right? So for example, you could invest in 3 deals, put 100K in one and deal one, 100K in deal two, and 50K in deal three. Now you're going to earn just a regular return, right? Just like the level one investors will earn that regular return. It's still a great return. But it's just not going to be that extra 2% higher than if you put it all into one deal. But you get the advantage of diversification. So if you're an investor who wants a little bit lower risk, then spreading that across multiple deals is what probably a better idea for you than if you're someone who can handle greater risk and is really looking for that greater reward. Now, one of the downsides here is you have multiple deals to track, right? So if you're involved in multiple deals, that means you're going to be getting at least 3 emails a month with updates on what's going on for these 3 different deals. Sometimes as an investor can get, if you have like 10 or 20 different deals, it can start to be a little bit hard to track them. One of the things that I like is sponsor teams who use a portal, an online portal for investors to be able to just log in and see all of their deals in one space, and they can take a peek at how each one is doing at any time, rather than having to try and keep up with all of those emails. But talking about spreading across multiple deals, right? So that could really help you diversify in many ways. So you could diversify across locations, you could diversify across assets, and you could diversify across asset class. And you could do all 3 of those by investing in 3 different deals. One of the drawbacks could be it's harder to find deals, right? So as a passive investor, it can be hard to find deals. So if you have 250K to invest now, then you're looking for 3 deals right now. So it will take some time for you to make sure that you get connected with the right sponsor teams. SteadyStreamInvestments can definitely provide you some opportunities to invest, but we would not have 3 deals at one time across different locations, different asset classes, right? Our cadence is usually every 2 to 3 months, we'll have another deal that comes up. However, we do diversify across locations and asset classes and asset types for you to have the opportunity to invest. So if you wanted to invest all 250K with SteadyStreamInvestments, that would mean that you would need to kind of wait, right, for the other assets to come, which you may not want to, and that's totally fine. And so then you would just need to go out and do more networking and find other operators who had investments that are ready to go, and make sure that you get, spend the time getting to know them so that you can diversify across multiple deals. Okay, and then finally, option three, you could take that money and you could invest it in multiple classes, right? Or levels is another way to think of it. Um, so sometimes when we have these deals, we'll break it up and we'll say, well, there's three ways to invest into this one deal. So one of those ways is to invest as a Class A investor, which means you are getting cash flow only, but you're getting higher cash flow than all the other investors in it, right? So the incentive here is to really focus on increasing your cash flow. Typically, that would be somewhere between 9 to 11%, and that's what you get. So say you invested $100,000 into this type of deal. So you took your 250K and you say, okay, 100,000 of that I want to put into cash flow so I can get strong cash flow. Then you would expect between $9,000 to $11,000 a year in cash flow over the course of the investment. That 100,000, however, would not be participating in any equity upon the sale at the end, right? So it's strictly a cash flow play. Now, then after you put $100,000 into that, you could put the other 100,000 or 50,000 into a Class B, which is going to be your cash flow plus equity. Now, if you look at the cash flow, though, on a Class B, it's going to be between 6 to 8%, so lower, right, than a Class A cash flow. And then also in these types of deals, the Class A investor is prioritized over the others, meaning that if at the end of the month we only have enough cash flow to hit the returns for the Class A, they're going to get it, and Class B will just get a little bit, right? So they may not even get that 6 to 8%, and in the beginning. And typically that happens in the beginning of a deal. So especially if it's a deal that we're going to go in and renovate units and increase rents like that, then typically in one of those deals, you're going to have lower cash flow in year one and possibly year two, but then cash flow will catch up and do well years 3, 4, and 5, right? So option three here is with that 250K, you can split it up into one deal. So you're still investing in one deal, right? Or actually, it actually would work to spread it across multiple deals, right? Too, but you're looking at investing in different classes or levels within the investment opportunity that comes up. So that gives you an idea of what you could do with your 250K, right? So invest it all in one deal, get that higher return. You could spread it across multiple deals to be more risk, to lower your risk, or invest it in multiple classes to kind of, change up the way that your cash flow comes in and your equity. All right. So one last thing I want to mention to you is that one of the easiest ways to diversify quickly is to invest in what's called a real estate syndication fund. Now, a fund, what it does is it pools together investors' money and it goes then uses that money to go out and buy a variety of assets within a specific period of time. So funds can be defined by like geography, location, asset type, asset class. There's multiple different types of funds out there that you can invest in order to really more diversify your investment. These ones that are not ones where you invest in a specific deal, right? So the trust factor has to be a lot higher here because you're not actually, as an investor, evaluating the deal yourself. But just keep in mind that this is another great way to diversify your money and do it that way. Okay, so now I'm happy to take questions. So please put those in the chat. And then also, if you want to learn more, I have a weekly newsletter sharing lots of insightful tips to help you succeed in real estate. I have a free course called Passive Investing Made Easy. Make sure you grab that. And also have some free guides, right, to help you get started on your journey. So you can find those at CamillaJeffs.com. Okay, so I'm going to open up the chat box and see if we have any questions in there. Okay, one question that came up is about locations. And they're asking, well, how do you know what is a strong location to invest in to be able to diversify, right? That's a super great question. So one of the things that we do as professional real estate investors is we go out and we study the data, we study the trends, and we study what's happening, the economics of the individual cities that we're interested in investing in. So we'll start with the big reports. There's a great one called the Yardi Matrix. And the Yardi Matrix will help us understand kind of where people are going. But then we'll whittle down and we'll start studying reports like the U-Haul report, showing us where people are moving to. Like, what are the top destinations people rent a one-way U-Haul from where to where? And that helps us understand what's going on. And then we'll get even more granular and we'll call the city economic team, and we'll understand what's exactly is happening in this specific city that we're looking to invest. And that's how we really look to find the best markets to invest in and the ones that will be strong for several years to come. Okay, another question that came up was, do you invest in multifamily only or other commercial real estate asset classes as well? So currently, like I said, 90% of SteadyStream's portfolio is in multifamily, but the other asset class that we have, and in fact, I neglected to mention that in commercial real estate, is senior living. So we are currently building a assisted living neighborhood is what we like to call it, where we're building large homes, so 4 large homes that have 10 to 12 bedrooms in each home, for assisted living for residents to be able to live there. So that's another great asset class. For this year, we're looking to expand, and we're hoping to expand into the self-storage asset class as well, and be able to offer that as an investment opportunity to the SteadyStream investor crew. Thank you for the question. And so thank you so much, everybody, for joining. Really excited to have you here. We do this twice a month so that you can just continue in your learning. So happy to share with you this webinar, and please join me again next time. Thanks, everyone.